Okay, we're going to get started by looking at the S&P 500 like we usually do. Um, this week we're going to start by looking at a 5-year chart on the S&P and how historic this point is in this point in time. We have a 200-day moving average that's held for pretty much for 2 years. We're at a point right now where it looks like we could either break the 200-day moving average or continue an uptrend. Um, and you can see let's go back to 2022. Let me see, April 2022. We were kind of flirting with the 200-day moving average. You can see right here, we broke through the 200-day moving average. We had some um, small rallies. Here's another rally. But it seems like at that time we were um, making a top and possibly moving down in a zigzag manner. We have a we have a time in the stock market right now where we are kind of reducing the spending in the federal government. We have um, we have a situation where we have consumer confidence going down, and we have fear in the market. And right now, and we have some pretty overvalued tech stocks that were leading this whole rally starting to fade. So this might be a time. The reason I'm bringing this 5-year chart up is holding the 200-day moving average is pretty major this coming week. If we don't hold the 200-day moving average, it could be very well like the January 22 when we're flirting with it, and then we started downtrend. So right now it's pretty important in the stock market that we hold this 200-day moving average. If we break it, we technically broke it last week, but it's still around that. If we look at our stochastics charts for the S&P 500, you can see that we're at the bottom of our trend line, which we draw at the bottoms of each of our when it hits the bottom of the chart and then in the top of the chart. So right now we're at the bottom. We're at a major decision point in the stock market. We're starting this little zigzag down. We don't have any, if we look at our meeting notes, we don't have any major um, earnings events until April. So we have to wait a whole um, month before we start getting earnings reports again. The one thing we do have tech-wise is we have a NVIDIA event where they're going to showcase some new technologies in the end of March. Um, and we do have end of quarter window dressing, and that's the best performers quarter to date are probably going to be bid up so that um, the top 10 of the mutual funds and hedge funds look good. And we have to watch out for triple witching day. It happens 4 times a year. That's on the 21st. So um, it'll be very volatile, but it doesn't necessarily mean it goes up or down. And we had the Fed meeting in the middle of the month. So in general, right now, we are we're at a historic place. We've been riding an up channel. You look at zigzag pattern. It's almost a perfect pattern for 2 years, 2.5 years, and where we finally hit the um, the 200-day moving average. Let's see what happens. But it seems like there's liquidity being pulled from uh, America's companies. We have the Fed. No, we have people losing their jobs in the government. We have people afraid. Almost 1 in 3 households are know someone that's got fired, so they're going to hold back on their spending. There's um, there's a lot of fear in the market right now. So because of that, we have to be very cautious, and it seems like defensive sectors are going to be more, um, or they're going to be bid up a little more than the tech stocks are. Let's look at some of our meeting notes. Okay, so um, S&P is down 2.5% since last week, so it's been a bad week. We have we're losing momentum in the stock market. Only 50% of the stocks in the S&P are above the 50-day moving average. So we've enjoyed above 50%, above the 200-day moving average for 2.5 years. But now it looks like we're losing momentum. And these are all kind of signs that we could be uh, going down for the majority of sectors in the stock market. Um, let's look at the treasuries. We have the 10-year up 2.5%, and the 2-year is down 5%. That is quite a dichotomy. I'm not sure why exactly we have that happening. But the stock market is oversold by all means. Let's look at some of our our strategies from the beginning of the year. We had a revert to the mean. Um, at the beginning of the year, we thought healthcare, telecom, financials, energy, and utilities, biotech, which did worse last year, will do better and return to the mean. The S&P right now is 22 PE, and overall, over time, it'll revert back to 15 PE. So we've had a flight to safety this week. Okay, so there's concern of tariffs and a lot of things going on. So we have a return to stocks that pay a dividend, that are conservative, and I think that could continue. Um, we have tariffs as things that could make the market go down. We have um, things that Trump does every day that could move the market, and we have the never-ending tariff issue, it seems. Um, so when we're looking in this environment, we have to we have to make sure we look at the PEG ratio of what we own and make sure that the company is profitable and doesn't need to borrow money. So we need to have we need to have stocks in our portfolios that are making money, that are their earnings estimates are increasing, and um, that are that are that are conservative. Okay, let's look at some more. Um, okay, so we see that March is traditionally a pretty decent month for the stock market. It's been up on average around 1%. And and April is actually even a better month. So we do have that in our side for the rest of this month. Okay, so let's look again at the S&P 500. We're oversold in a major way. We're like 16 in the slow stochastics, and that matches up with the bottom. If we were in a normal environment with our input variables the same, we would be still in this uptrend. But right now, we're actually some of the variables that we've been using for forecasting stocks going up and down are unreliable due to the tariffs and craziness that's going on in the Trump administration. So as soon as we break out of this uptrend, basically we can't use stochastics anymore for um, whether stocks is going up and down or up or down. This only works in an uptrend, these stochastics charts. And you have to understand the limitations of that. Okay, so go back at our meeting notes. Okay, let's look at the 10-year treasury. 10-year, okay, let's compare it against the S&P. Okay, so now this has been an inverse correlation for going back a couple years now. And right now we have the interest rates going down and the stock market going down with that. So in other words, this is the translation that the economy seems to be slowing. As the interest rates go down for the 10-year, the U.S. economy is expected to slow down with it. So that is kind of a bad sign because a lot of the companies that we're following don't get as much money and don't make as much money whenever there's a slowdown. All right, so look at our input variables. Price of oil is going down. And, this is another hint that the economies around the world are slowing. So as the price of oil goes down, that means there's less demand for oil around the world. So there's less trucks delivering things in America. So that means there's less fruit being delivered, etc. So, so this is a hint that we could be going into a recession. That's kind of we have a lot of hints that the economy is slowing anyways. And we have some very famous economists like Ed Yardeni that said this week that the chances of a recession are going up. So we have to keep that in mind because whenever you're investing, you have to understand the growth stocks part of your portfolio are not going to do as well in a slowing economy. Um, okay, so inflation hasn't changed. It's still around 3%. The US dollar index is down 3.6%. Um, so so every move up of 10% equals 3% hit to earnings. So every move down 10% will help the S&P earnings by 3%. So that means that'll help the earnings of the S&P as the dollar index goes down. You can see, okay, so we're in a downtrend in the US dollar. Gold is up 2%, and as this, let me see, as the stronger US dollar tends to drive gold prices lower, and conversely, a weak US dollar drives gold prices higher. So that matches our pattern there. Okay, so let's look at fear greed index. We're at extreme fear right now. Last week it was 20, and this week it's 20. So investors are fearful. They're extremely fearful, and um, the translation is to when people are fearful, you have to buy or don't sell. We have um, let me see. We have one of the largest um, bear market. I mean, the the AAII survey shows that their people are very bearish right now, and they're more bearish now than they ever have been. Um, so, I mean, this goes back to the crisis of the financial crisis and to major events, and we are only down 6% on the S&P 500. So it's very strange that we have such a weak confidence in investors. So we're right now we're at 23 in the VIX. So what the VIX means, it's basically a sign a measure of volatility. So when a VIX is around 20 to 25, that implies a volatility of like 1.5% a day in the S&P 500. And that's what's happened in the past week. So we're having a lot of volatility, and that's leading to lack of confidence in by market participants. And sometimes when you have lack of confidence, the stock market goes down, but we'll see. Um, so right now we have fear in the market, and that is in our emotional graph. That's the time you want to start looking or not to sell. If we look at our chart for the PE ratio versus the interest rate, every time this is the X is where we've been at before in our rates. basically right now with PE ratio, the stock market is between 21 and 23, and the average is 15. So every time that we've had in the blue mark, in the blue, the blue is the interest rates. No, the red is the interest rate. So every time the red is at 4% interest rates, um, we paid 15 times earnings. So basically we have, it's 35% less than where we're at now. So we can easily correct 20% in the stock market and be in at the historical average to the S&P 500. This is our chart for worst to first. At the beginning of the year, we looked at the worst performing sectors from last year, and which were real estate, healthcare, energy, consumer staples, and materials. And now it looks like they're actually outperforming the other sectors of the stock market, like we were predicting. So um, our theme for this year was investors will be reaching for stability amid chaos. Um, Investors don't like uncertainty, and every day we're presented with um, different scenarios by the president that makes investing almost unpredictable and um, it's very hard to predict the earnings of stocks when you have a constant change of the variables, such as tariffs. And so people are now reaching for these utilities, healthcare, and consumer staples. You can see that healthcare is up 8%. It's the best performing sector this year. And consumer staples like Procter and Gamble, you buy the soap, Tide, and those kind of items that consumers have to buy. Um, that sector is up the most, is second to best, and then real estate is up third best. Um, we're going to have declining interest rates this year. That's another theme. I was wrong with this interest rates higher for longer at the beginning of the year. Actually, companies, we're going to have lower interest rates because it seems like the president is tanking the economy and that'll make interest rates go down and that'll allow us to manage our debt payments better, it seems. So we're having a weaker dollar and companies overseas um, will be positively affected. So what's happening right now is our dollar is going down, and that makes the overseas investments more profitable. And that's why we're seeing European companies and Chinese companies outperforming this year in the stock markets. All right, so all right, let's look at okay, so this is another look at at the sectors. Um, Healthcare, consumer staples, the best sectors, materials, real estate, financials, and industrials are the top picks. And the worst performing are the tech stocks and communication sector. All right, let's look at some of the stocks moving up and down today. We have, see, okay. Okay, Broadcom, they came out with decent earnings. So stocks around that medium are doing well too. So, you see, okay, Jan Smucker Company, they do jelly, and that's an example of a staple that people buy in good times and bad times. We have no real theme here. Do we have a theme? Okay, a lot of these stocks rallied a lot last year and went down. Now they're bouncing. That's the theme of most of these stocks. They're very volatile. The ones who went down the most, Hewlett Packard had a earnings report, and it wasn't as good as expected. So um, that's why it's down 11%. Eli Lilly is down. Not sure why. They're a healthcare stock that does weight loss drugs as the major part thing that they sell. And let me see. Okay, I think a lot of these are, some of these are consumer discretionary stocks. That means that people don't need to buy them, but they're like a luxury good. So Tapestry, they do Coach Coach handbags, etc. And you see Decker's Outdoor shoes, luxury shoes like Uggs. And okay, Vulcan Materials. Vulcan Materials does, um, they make materials for building streets and roads and buildings and things like that. All right, so okay, I don't see any commonality in that, but let's look at some of these sectors going up and down. So let's look at our 10-year first. We have a declining 10-year. It's gone up a lot in the last week. So let's say it's going down. So our cheat sheet for if the 10-year is going down, that's good for high yielding stocks, healthcare, um, consumer staples, and home builders. It's negative for large caps, tech stocks, financial sector, banks, insurance companies. So let's look at the market movers, not the market sectors. Oil ETF is up the most. Um, Utilities, energies. Okay. So I guess that follows our theme for this. Investors will be reaching for stability amid chaos. Utilities, healthcare, consumer staples, and the worst the first. These are all these are sectors that did the worst last year. So if you see oil, utilities, energy, and okay, so that kind of makes sense. And the ones that did the worst are materials, financials, home construction. So home construction will do good when interest rates go down. Hmm. Okay. All right. All right. That was a good little excursion. All right. So now let's go to our next talking points. Let's go to what Dan now said at the beginning of the year. Here are his picks. ADTN up 10% so far this year. Cisco up 8%. IJJ is down 2.2. KWeb, this is a bank ETF. It's down almost 3. And cash, yeah, it's turning out this cash is turning out to be one of his best performers because the S&P is down like 2% this year, and his cash position is earning 4%. Um, so so he's going to be, and he's actually looking to buy things now with some of that cash because he says some of the top stocks in the stock market are doing well now, or are not doing well, and he's ready to buy them. Let's look at we're going to go back. We're going to review Dan Niles' picks a little bit later on. Um, so it seems like I'm going to keep going back to this comment. Um, so what's happening right now is we're reducing the federal, we're firing people in the federal government, reducing the debt by reducing expenses and getting rid of unnecessary expenses. So we're having a situation because the government is kind of propping up the economy by spending money. We're approaching a time where we could have a recession. There's 75% chance of recession in the next 3 months. That's one headline. We have whipsaw, that's Donald Trump tariffs on and tariffs off. We have unemployment going up this week, 4 to 4.1, and we have less expected job growth. So we have all these hints that the economy is slowing, and it just seems like this idea where we could be going into some kind of recession or some kind of slowdown this year. It's adding some, and if we do go into a recession, the interest rate on the 10-year will go down lower. And I think that's what this administration wants. And if that happens, um, then the interest payments for the United States go lower and it's more manageable. And on top of that, the stock market is not going to do good. It's going to correct. So, so this is a comment. There's an op-ed by Ed Yardeni. He wrote this article that says um, we have a 55% chance of everything being okay this year. We're going to assume the trade war doesn't escalate. Everything will continue our uptrend. He says the chance of a melt up where we go, up like 10% is 10% down from 25%. And he says we have a 35% chance of going into a recession in a bear market for stocks. So he was 20% chance of going into recession, but now it's up to 35% because there's a lack of confidence in CEOs and there's lack of confidence in investors. Every day we get a new whipsaw tariff threat, and countries are actually turning against the United States, not buying our materials. Like in Canada, we have a boycott on some spirits and alcohol that's sold by American companies. So I don't know. It's getting to the point where it's unpredictable, and it's going to be very hard to invest in this environment. And Ed Yardeni, he's really famous, and if he says that, we might have some problems. Um, okay, so there's another article that this guy says there's a 75% chance of a recession in 3 months. That's 3 months. Um, and his rationale is conventional estimates understate the likely impact of the economic activity of the trade war and the Dodge cuts. Implied growth is slower than expected. So his theories, there's three underpinnings to his predictions. First, higher tariffs hammer the real incomes of workers, which slows demand. Two, the shoddy way tariffs policy is being handled is raising public and business uncertainty. So businesses aren't going to build factories or start new projects because they don't know how much tariffs are going to be applied. And it's really hard to invest in this kind of environment. And even consumers are not going to go on vacation if their daughter-in-law is fired from the government. There's like uncertainty. Lastly, tariffs are likely to push up inflation and make the Federal Reserve less willing to cut interest rates. So JP Morgan also slipped a warning about a slowdown. So we get all kind of hints right now that we're going into a slowdown period, and you just have to make sure that whenever you're investing in this time, that you position your portfolio for the stock market to go down or sideways for another year. Okay, so here's a comment by Dan Niles. We just talked about Dan Niles 5 minutes ago. He said in an interview that certain tech stocks are getting to levels where I'm probably going to force myself just based on statistics to pick up some of the names I've been waiting for. And this is based on, his calculation of the fair value of stocks. And so he says at the beginning of the year, he had a possible outcomes from negative from plus 20, plus 10% to down 20%, and he still thinks that's the case. Let me see. So he still thinks that the cash has been the best performer this year of all of his picks. And last time he picked cash, the S&P was down 20%. So he really thinks we're going to go correct 20% in the stock market still as of today. And he said the underperformance of the Mag 7 is actually down 10% and the stock market is down 2% this year. So it seems like the earnings estimates are getting cut for the Mag 7. And we're following that every week too. So we know the fair value of Tesla is um, 3 times lower than it's at now. So we have to make sure that whenever you invest in a company that you know what its fair value is. And let me see. Okay, AI results are weak in the earnings reports that just came out, and the valuations um, were very high at the beginning of the year. All right, and tariffs were a main reason for the stock issues, and that's why a lot of the foreign stock markets are doing better than the United States. Um, so he says his K-Web is up 17% year to date versus 10% decline for the Mag 7. So he says tariffs will ultimately sort themselves out to pretty soon, and because no foreign country wants to lose access to the United States customers, which are 1/6 of the global GDP. Um, okay, so he said last time Trump did this, in his first administration, the stock market was up 14%. So don't lose faith. All right. Um, okay, so he also said in his final notes, it's not the strongest nor the most intelligent species that survives, but the one that is most adaptable to change. That's why he does contrary investing. And, he was in cash when everyone was, anxious to buy the stock market at the beginning of the year. And he also did the China trade when it was totally out of fashion last year. So, okay, let's look at a note from Bank of America. It thinks that NVIDIA stock price will jump more than 50% as the chipmaker remains a dominant position. Okay, so we know that NVIDIA is undervalued right now because of its PE, its PEG ratio, but that doesn't mean it can't trade down a lot. I mean, right now it's $111 a share. Its fair value should be higher than that, but it could easily trade down to $70 a share based on some of these triple levered ETFs and a lot of things that are going on in the stock market. Even um, if the S&P trades down, all stocks in the S&P go down with it. So you just have to be watching the fair value of stocks whenever as you invest in the stock market. Okay, so let's look at the T. Rowe Price Science and Tech um, top holdings. This guy named Tony Wang, I think his name is, he was on a CNBC show about his current picks, and he was saying Meta is one of his best his top picks right now. It's up 11%. Now it's 11% of his portfolio, which is pretty big. Um, and Microsoft, Apple, and NVIDIA are the top five, and then Broadcom. Alphabet is actually, if you put the two, no, actually, yeah, Alphabet is next, and then Amazon. So he's not moving into other stocks yet. So this has been his top picks for quite a while. Um, if we look at some of our top performers and worst performers of the year, you can see Tesla is down 30%. Um, but it ran up 30% after Trump won the presidency. So it's kind of like um, he gave up all of his gains from the Trump bump, if they call it. NVIDIA is down 18%. Um, we have, you see, the ones doing the best are drug stocks. Amgen up 25%, Abbott Labs, um, and T-Mobile US, and AbbVie. Okay, and these are telecoms and drug stocks in the top stocks that are up so much this year. And here's more telecom. Okay, so we have our theory starting this year was actually pretty good, and it worked out pretty good. The utilities, things that are paying dividends and are safe, are doing much better in this environment than the tech stocks. Okay, so um, we have more articles this year this week about Trump and his tariff crusade. We have Trump's delay on Mexico. He puts tariffs on, takes tariffs off, threatens tariffs, and at the beginning of the year we said chaos is coming. That was like an understatement because companies are having a hard time adjusting to this reality, and because of that, it could make the economy slower and make the stock market go down. So um, we'll just have to watch and see if it settles down from what's been going on. Okay, let's look at some of our let's look at some charts. Okay, let's look at the healthcare ETF. You can see that we've been in a trading range for a couple years right now. The dividend paying stocks haven't gone up really. But now you can see that they're forming this nice uptrend. They're overbought, but you can see this is becoming the new sector that people are rotating into. And let me see. And let's look at okay, let's look at this article by John Ehrlichman. He said the expected profit growth in the next 5 years. Tesla, Nvidia, Amazon, Netflix, Microsoft, Apple, Alphabet, and Apple. You can see how big a difference is between the profit estimates. And this guy uses the same techniques that I use whenever I look at profit growth. I look at a chart. We'll go over a chart. Um, okay, he looks at earnings estimates like I do. Hold on for a second. My printout didn't come up, so I have to go back and look at it again. Okay, this is a little better. Okay, okay. So now we're back to normal. Um, we're gonna look at charts right now. We're going to look at some charts that I thought were interesting. First of all is the consumer staples. Okay, consumer staples, this is like Procter and Gamble, stocks that toothpaste companies, these are stocks that you have to buy, as a consumer. You can see that in an uptrend very similar to they're in an uptrend very similar to the healthcare stocks. And and they're overbought right now. But it looks like these sectors are going to be doing much better than the regular market. Let's look at Alphabet. You can see it's been in an uptrend for multiple years, and it hit the bottom of its channel, and you can see that it's oversold. And as we can see on our stock screen, the PEG ratio of Google is 1. So this is like a trough level for Google. It doesn't usually trade at a PEG ratio of 1 for a stock that's pretty consistent in its earnings. And let me see. So let's look at the next little stock we're going to follow here is Berkshire Hathaway. You can see that Berkshire Hathaway is an example of a stock that isn't as much affected by tariffs as other companies because it does most of its businesses are in America. Railroads, and you have insurance, Geico, you have they buy a lot of companies like See's Candy. Most of them are America based. So they're not as affected by tariffs. And they have a lot of cash. They've been selling off a lot of stocks last year, preparing for some kind of downturn, maybe. I'm not sure. But so they're in a very good position to take an advantage over take advantage of a slowing economy in America. So it's an example of a defensive stock that people can buy now even and would do well in the next in the throughout this recessionary time we might be going through or slow down. Okay, here's another stock, NVIDIA. You can see that it had this multi-year. I mean, this is since a couple years of an uptrend, and it broke through this channel, and it's starting to make this downtrend. Look at that. So we're at the bottom of its new downtrend. Whether we get back up to this channel of going up, it doesn't look like it. It looks like it's going to be going sideways here. And we're oversold for NVIDIA too. So the company can still be firing on all cylinders. I mean, according to the last earnings report, it's doing really good and they gave good estimates. But if the stock could actually be in its own world and trade separate from its valuations. So right now we have even in its new pattern, it's at the bottom of its range. So, but it does have a catalyst at the end of this month of a developer conference. They're going to announce some new things, so that could make the stock go up a little bit. Let's look at Eli Lilly. Eli Lilly is up a lot it's up 11% this year with the drug stocks. It's overbought right now. It's an example of a stock that's growing at 30%, and it's $1 trillion valuation. It's a lot. It's like a big tech stock, um, but it's in the healthcare sector, which is outperforming this year. Um, okay, here's another comments by this guy named Michael Gayed, and he's um, he's predicting a liquidity crisis, and that means that's something like the financial crisis. His main theories are that there are some major players that are borrowing from the Japanese at low rates and investing in high-flying tech stocks like NVIDIA and the Mag 7. And eventually, because of interest rates in different countries, that'll unwind, and then people will sell the Mag 7 and a lot of the S&P 500 stocks, and I'll make like a crash situation. So I'm always watching what he says to see if there's any gradients in it. And he's been saying this for a couple of years, and it really hasn't. It happened one time, like last year, whenever we had a um, Japanese um, yen carry trade. And he says it's going to happen again, but he's giving all these hints that that banks are not lending as much. We're having corporate defaults. A lot of he says we're due for a global margin call. So if any of this happened, you have to consider the fair value of the stocks that you own. And if you have a stock with a peg ratio greater than one, you got to be willing to hold that stock as it goes to a peg ratio of one in a bad market. So that's why every week we review the peg ratio, the fair value of stocks, and where a stock could go if it, traded down to its fair value. Okay. And we already mentioned this already. We'll go over it again. Um, this guy thinks that based on current estimates, Tesla will grow 258% in the next 5 years. But Elon Musk said it will require outstanding execution, but I think more like 1,000% gain is possible for Tesla in the next 5 years, and that's possible. So we have to watch Tesla. Right now, we know it's overvalued, but there's a lot of things not factored into the price of Tesla, such as the robots that they're making. Elon Musk thinks that robots will be the biggest personal assistants, and robots will be the biggest consumer product of all time. So if Tesla gets sold off and in a major way, we're gonna look at the fair value and see if it's even worth starting to invest in it. Okay, so let's look at Tesla in some of the earnings estimates. We can see that Morningstar thinks that the fair value of Tesla is 1.5 times what it's worth right now. So it's overvalued by 1.5 times. And CFRA thinks that it's overvalued by 38%. So so we have two indications by that it's overvalued. Um, CFRA says that they have a buy rating on it. They said shares are deserving of higher multiples based on favorable view on regulatory approval timeline for their autonomous driving technology. Um, but you can see that the PEG ratio for Yahoo Finance is 3.71. Okay. Their market cap is around a trillion. Their forward PE is 90. That is really high. Their profit margin isn't that great. It's 7. We like to have stocks that are um, at least 11 or 13. Return on equity is 10. That's like barely minimum. And the total cash, they have more cash than debt, so they don't have a cash problem. Okay, so right now the earnings estimates, they're not that great. They're 14%, 33%, 16%, and 32% going out a couple years. So this is where that guy said it's estimated that Tesla is going to grow at 300%. Um, so right now their PE ratio, forward PE ratio is 89. Let's say they're growing at 33% this year. Then the PEG ratio is 3. And that's not even taking account they're only going to grow 16% next year. So the fair value of Tesla is somewhere around $100 a share. That means if the PEG ratio is 3, you divide the price, which is 300 by 3, and you get so if the stock market sold off 20% like these people are saying, um, Tesla stock is probably going to go down to $100 a share. And that's the fair value of the stock. And if Elon Musk thinks it's going to grow 10,000 times in 5 years, he has an idea, you know, how that's going to happen. This might be a good time to buy that stock. All right, so some negatives for Tesla. Elon Musk is being hated for political stances all around the world, in America, in Germany, in China. So that is totally affecting who's buying Teslas around the world. There was a huge drop in Germany and China demand for Teslas. And so that's an intangible. But some positives are Elon Musk is probably the greatest inventor of our time. Um, he's almost like an Einstein, according to Jamie Dimon. So there's a lot of new products in the pipeline, robots, robotaxis. So it has a great future. Right now, it's overvalued. So it's really hard for me to invest in this kind of stock right now, especially with these elevated valuations. If there's going to be a potential slowdown in America, people are going to be buying less Teslas and every other product in the country. So um, whenever you're investing, you have to invest with a margin of safety. And if you bought Tesla at $100 a share, then you'd have at least a margin of safety. But if it turns out that it only grows at 16% like this from this year to this year, um, then it's 6 times overvalued. So your fair value price would be $50 a share. So that's why it's important to keep track of these growth estimates. Um, so if this ended up turning to 16%, and then we would only pay $50 a share for the stock. Okay, so let's look at this price of stock Tesla right now. You can see this uptrend. It's been in place for almost a year. Um, it went out of whack after the Trump presidency, but it's back down to this trading range. But you can see where, just like the U.S. stock market, it's at the bottom of its range and it's oversold. And so we can go two ways. We can continue to go down in this blue lined chart, or we can go up in the black lined um, trend lines. So with the stock market and most stocks that we're following, we have that decision time. So we don't know which way it's going to go. Um, this guy, John, also mentioned here's a list of 25 stocks expected to see profits double or more. And they can see a lot of these are ones we're following. AbbVie, we're following Amazon. We can see Eli Lilly and Meta. Whenever some people, mention the stocks that you're following, it's a good indication that you picked some pretty good stocks. Nvidia and Tesla. So he thinks Tesla is going to be doubling also. Um, so okay, we mentioned this article 2 weeks ago, Brace for Lower Growth and a Significant Correction, says billionaire Steve Cohen. So we have a lot of indications that sticky inflation, slower growth, austerity in the government it's a recipe for stock market going down. And so you can't get too over leveraged, or you can't get too excited about stocks going up. You got to be a little bit more conservative in the next year. Okay. Let's look at some of our let's look at some of our stock screens for this week. So what I do is I sorted by market cap, because usually the larger companies are a little bit more reliable over time. And we see that a lot of the stocks, I like to look at the PEG ratio as a really important determination of whether a stock is overvalued or undervalued. And it doesn't tell the whole story, but it really gives you an idea of stocks to look for whenever the market's crashing or the market's correcting. So you can see the alphabet is right around the PEG ratio of 1. And according to this, Merck is a PEG ratio of 0.24. We have Morgan Stanley. People are um, at the beginning of the year, we were saying Morgan Stanley and Goldman Sachs would have better business in an environment where there'd be lower regulation and more IPOs. But people are still selling that stock. We see Goldman Sachs is it's a PEG ratio of 0.5. That means it's half valued. And we can see PDD Holdings. They are the Temu parent, JD.com. These are Chinese companies, and they've been on our screen for a long time. But only recently, um, the Chinese stocks have super outperformed the rest of the market. So that's interesting to go over um, this stock screen, and look for companies that may be thrown out with the bathwater. And I like to look at the PEG ratio. According to this, Uber is 1/3 the price that it should be. And let me see. All right. So this will be more interesting. If we have a stock market correction, we're going to see a lot of big tech companies with a PEG ratio of 1. And if that happened, then you'd have a much better entry point and a margin of safety um, to buy your stocks versus right now, because a lot of them are super overvalued. Like right now, we have Apple like multiple times what it's should be trading at. Okay, so that's all I had for today. I hope you enjoyed that. I hope you have really good investing.